Hi, everybody. It's David Roach from Independent Strategy on COP26. COP26 has ended not with a bang, but with a whimper. The question is, what has it done to us, not what it has done for us? Let us first of all say that the overall commitments that it sought to make to reduce greenhouse gas emissions were a reduction of 52.4 gigatons. It has come up with less than 26.6, and it is mealy-mouthed in its wording. For example, on coal, it has simply said that we will phase down coal. That is a phrase I've never heard before in the English language. It is completely meaningless. It lets everybody have the wriggle room to do whatever they want to do, including China. Now, let us just look at this for a minute. Greenhouse gases total emitted in the world today is 31.4 billion tons a year. Of that, 14 billion is coal. Of the 14 billion, which is coal, 1.6 billion is India and 7.4 billion is China. If you take total emissions in the world, then India and China are between 50 and 100% bigger than total emissions in the US and Europe. But the commitments to reduce these are simply not there in any meaningful terms. What does this actually mean? Well, it means that we're heading towards the 3% plus increase, 3 degrees plus increase in global warming by the year 2030 or 2035. It doesn't really matter whether you get exterminated in 2030 or 2035. It proves that politicians are incapable of taking decisions which incur short-term pain to make a huge long-term gain. And so whether they are totalitarian leaders or whether they're democratic leaders, they can't make decisions that really matter to the world. In terms of the world economy and what happens to you, there are two impacts among many, which I will mention. One is supply side disruption. Well, what you're seeing as regards supply side disruption in the world today is just the trailer to the main movie. It's a tiny episode compared to the disruption to supply chains, which will happen as global warming occurs, which is now baked in the cake. It was pretty well baked in the cake anyway, because the amount of greenhouse gases which you already admitted had not yet had their full consequence on global temperatures. But this meeting and its total lack of any meaningful results means that the climb in global temperatures will increase exponentially and accelerate for much longer until we're probably, most of us, and certainly the poorer, a couple of billion of us, will not be there to count the cost. That's the first implication. It's an economic implication, which is what I am here to talk about. The second implication is as regards your pension fund, your assets. Well, your holiday home in a low-lying Caribbean island will probably get wiped out, but I don't really care too much about that. It's not essential to living. What is much more serious is that the duration of equity markets today, which is the period of time before you get your money back, which you pay out to buy the equity today, is 30 years. So it takes 30 years to get the money you pay for an equity today back from that equity in terms of increased dividends, etc. And that is an extraordinary state of affairs. It has never been that long. So it is as if you were buying a 30-year bond market without the guarantee of it being a liability of a corporation or a state to actually pay the money back. In an equity market, you're dependent upon the fortunes of the company, which even under a normal circumstances, which I've just explained why the circumstances are not going to be normal, it would take you 30 years to get your money back. So if you know something about the world in 30 years' time, which I do not know, then you should definitely continue to buy equities. If you understand the sort of disruption which global warming is going to cause, and is now guarantee to cause, then you would not invest in any investment which took 30 years to pay back. And you would not invest in any investment where the terminal value was a large part of your total return. In other words, if you buy a bond today at, say, 0.9% interest rates for Italian state bonds, and it's a 10-year bond, you are relying for your return on the terminal value of that bond being 100% of par value being paid off by the state. Now, what I'm saying is this: any investment which involves, as part of its return calculation, a high par value is much more risk than an investment where the yield, the current yield, either dividend or coupons, pays off that investment in a short period of time. And the reason why that is true is because what is not coming over in economic calculations and investment calculations today is the fact that terminal values are at risk. Any long-term forecast is at risk from the fact that climate change equals massive economic disruption. We just do not know the exact date, but what we do know is that we do not know enough about a time horizon in excess of 10 years to really count on anything beyond that to add or complete the returns which we could calculate today. That's it for me. And there is far more to say about this in terms of how 50% of the population growth in the world is going to be in places like sub-Saharan Africa, and where already 1/3 of the world's climate changes occurs. None of the world's greenhouse gases, virtually about 5% of them, are emitted by this area, but these areas are condemned. So are the low-lying Pacific Islands. And we could talk a lot about that. There will be a lot of people talking about that. My job is to translate the inaction of our fifth-rate politicians, maybe as 20th-rate politicians, and what that will actually mean in terms of disruption, supply and demand-side disruption, the consequences of that for the economy, the consequences of that for the portfolio, which you may be relying upon to have a comfortable retirement, which will not come through. Thank you for watching.